Yeah, thank you everyone. Thank you everyone for joining. Just a few housekeeping matters before we start. So as you may have seen, we're going to record that session, so we will make it available to all of you afterwards as well, so you can rewatch it or share it with your network. Please feel free to do so. We will start with around 25 minutes of an initial panel of this group that I will introduce in a second, and then have 30 minutes of Q&A afterwards, where you will be absolutely free to join. So if you have any questions that pop up during the panel, please note them down, and we will then open the floor afterwards for all of you. In order to be able to ask your question, then please raise your hand. We will upgrade you as a contributor, and then you can unmute your mic and raise the question. We also received some questions in advance, so we have a few prepared too, from folks that shared them with us and but can't join. So, but yeah, we are really looking forward to engage discussion afterwards. All right, let's get started then. So the topic of our today's discussion is on-site solar for property investment enhancement. So what does it actually mean? So we want to cover the following topics in our discussion. So the current markets situation for on-site solar, particularly in the UK. As part of that, opportunities and challenges for on-site solar, as well as its impact on valuations. And yeah, we want to give you also some insights on a range of delivery models to unlock its potential overall. I would like to introduce our panel. So we have Chris Warren here, Director Natural Resources at Harworth Group. We have Emre Karagozlu, Renewable Energy Lead at JLL. We have Ryan Loftus, Head of Commercial Real Estate at InRange, and myself as the moderator, former Head of Real Estate with Wayfair for Europe, Asia, and the Global Renewables, and now currently advisor and consultant. All right, let's get started. Thanks all for joining. So maybe to kick it off, and to provide a little bit of more of a holistic overview on the current market situation for on-site solar before we dive in more details. Emre, JLL, you and the team, you recently shared some insights on the state of on-site solar in a report that you circulated and shared around a month ago. Maybe to begin with, could you share some highlights with us that you covered in the report?
Sure, thank you, Peter. So the title of the paper was The Value of Solar PV in Real Estate. In the paper, we focused on some key aspects, and today I will be speaking about 3 of them. The first one was identifying the appropriate ownership model for the solar panels, where we explored various ownership options. Ownership models are important as they will impact the level of upfront investment required, as well as the level of control that will be maintained over the investment. And there are 2 main structures, landlord-owned and third-party owned. When it's landlord-owned, it's the most direct form of investment. The landlord invests in the solar PV and sells the energy to occupiers, and then the excess is being sold to the national grid. This creates full exposure to complexities, risks, and costs of PV investment. However, it also allows for the greatest potential revenue generation and return on investment. And I will be touching upon that soon. The second one is the case where a landlord leases the roof to third party. In the structure, the upfront costs are met by the third party, which can be the occupier owning and operating. Sometimes it's the occupier renting it to another third party. It could be a specialist PV provider or a separate energy investment vehicle. Now, this is what we discussed in the paper, but when we had chat with our clients, investors, asset managers, we found out that there are many parties who had a premium on the base rent they have for the real estate, and then provide the energy free of charge to the tenants, occupiers. On the other hand, there had been many cases where we see that an asset manager or investor rent the rooftop panels to a related party, an SPV most of the time, and then SPV sells the energy to tenants for tax benefits. This was the first aspect we focused on. The second aspect was the valuation of solar PV. Now, when you traditionally value a real estate, you would get the tenancy schedule, put it in a model, and then you would have separate lines for income from car parking, let's say commercialization, and energy would be another income line. As a modern best practice, we ensure that solar PV energy income should be valued separately. This can happen in two ways. Either you would, if you are valuing the whole thing, the real estate and the rooftop solar PV, you can have an independent cash flow for the energy income with solar PV for, let's say, 25 years with its own unique assumptions on income, expense, capex, its own profile for the yield and discount rate. And when you arrive at value, you can add this value on top of the value you get from the real estate. Alternatively, you can still keep this as a separate line in your valuation model of the real estate. But if that's the case, again, we must ensure that all the assumptions unique to the energy income should be allocated rightfully. And when a real estate with rooftop solar PV is valued, there are elements of the real estate assumptions around ERV, leasing, etc. And then there are elements for the rooftop solar PV maintenance, changing of the inverters in the future. The interaction between the two and the impact of one another shouldn't be missed. Because if this is a real estate with solar panels, it may be more attractive for occupiers. And in that case, you may be able to have assumptions in your valuation for lower void periods, lower rent-free period, higher rents, higher rental growth. If a valuer misses to adopt these, there could be a risk of undervaluing. On the other hand, if all of those are reflected and on top the yield profile of the real estate is also adjusted, then there could be a risk of double counting or overvaluing. Now, in our paper, this is the valuation, how we approach it. We also tested a few scenarios on what the value would be if you rent it to a third party compared to if the landlord owns the panels. And it turned out that you would be arriving at a value around 150K in the case where you would let it to a third party, compared to a value of between 860 to 1.3 million if the landlord owns and operates the panels. So we can conclude that it's usually significantly bringing you significantly higher profits if the landlord owns and operates the panels compared to letting them to third parties. Finally, there's one more aspect I will be quickly touching upon. We had conducted a mixture of market surveys and interviews to explore how leading investors and asset managers are incorporating PV into their operations. And it turned out out of the participants, currently, share of portfolio equipped with PV is mostly between 5 to 25% at the moment. But the same participants indicated that they have a target to have at least 50 to 75%, and even above 75% of their portfolio to have solar PV very soon. So that shows us the direction of travel with solar PV panels. And we asked who installs and operates the solar panels. 37% said third parties do it. 37% said landlord would do it only. And then 25% of the participants said that they have cases for both, where they are operated, installed by third parties and landlords. And finally, we asked if this is self-operated, how is the solar power used? 57% of the participants said that they would be selling the energy to their tenants only. 14% said they would be selling to grid only, and 29% said they would be selling to both grid and the tenant. So these are the main aspects I wanted to touch upon today.
Okay, thank you, Emre. This clearly shows the variety of options that we have here, to maybe so really appreciate it. It sets the tone a bit.
If just I'm in there, Peter, too. I want to say, and I could probably maybe speak for you and perhaps Chris, but also just the broader market. I appreciate that JLL took that first step of trying to analyze and value it, because it's been, at least personally speaking, it's been screaming to me that a lot of people are still hesitant to adopt solar because they don't know how it's actually going to be valued over time. So it's good to see somebody out there who's starting to consider it a little bit more forward thinking and progressive on that front.
Yeah, and if I can jump in on that point, it's very rare, but I actually agree with the value of this one. Yeah, it's really pleasing to hear that we're getting a slightly more consistent approach and how we look at this. Echoing what Ryan's just said, yeah, there is still some skepticism. There's still some reluctance in there, and from the developer's perspective, it's quite often to do with getting the investment case to stack up. You know, we know this is a good thing. We know there's additional income. But if I'm going to put in CapEx into this, I've got to see how I'm going to realize that in the additional value of the unit. So yeah, this is a great development.
Perfect. And like, maybe continuing with you, Chris. So as a developer, or like as a representative in this panel, from a developer side, investor side, so what other key challenges do you see at the moment? I think that would be very interesting to hear, particularly based on what Emre just shared.
Yeah, I think we'll all start with the most obvious one and the key one, which is grid. You know, this can be a great idea. We can have the investment case, we can get the valuation advice, we can get development partners to work with. But as it stands at the moment, the whole grid process is far too slow. It's far too expensive. But the worst part, actually, beyond both of those, is even when you get that grid offer, it doesn't mean you've got it. You know, the T's and C's that we all, for years and years, didn't really read. They can withdraw your grid application, and you know that is possibly the worst thing that can happen when, as Emre says, you've just paid £1 million to put solar panels on the roof of a unit. You've got the model that works with a sell to the tenant and export, and suddenly that export element is lost. I think the next bit for us is the market sentiment. It's still not quite there. We are still coming up against tenants and to a certain degree agents who are not seeing the benefit of solar. You know, we still talk as an industry about eave heights, you know, number of docks, and they're important, they are. But if we're going to put solar on the roof of a unit and we're going to save the tenant £120,000 in electricity costs over 10 years from green energy, that should be forward in what we're speaking to the market about. And at the moment, it's still something that's not quite being picked up on. I think other parts for us is Harworth has a large, extensive existing portfolio of units. And we're finding that the approach that you're going to take on a refurb, an existing unit, might be different to the kind of approach that you take on a new build. Particularly to do with the WALT, the remaining term, lease term length, because the voids, and I think Emre will agree, hammer the valuation. So, you know, we've got to think about that. And then the last one for us would be a personal experience on planning. We all know that we get PD rights these days. There are certain circumstances where it doesn't work, but we've had the experience where we showed solar on the roof, which is great. We then went back to want to put more on, and the planners was like, I know you've got PD rights, but now you're not complying with the planning that you put in because you only show between 5 and 25% of roof coverage. Now you want to expand it. That's become a variation. That's become a non-material amendment, and we're getting delays through planning. So they're the kind of key things that I think as a developer we're seeing at the moment.
You know, on that last bit, especially, you know, we find, and I want to touch on the grid bit too, just briefly, but we find getting out in front of some of that planning up front, because all too often you will hear there is, you know, a varied process each time of, well, here's one installation and then later on another installation. You know, we personally believe oversize from the get-go and you know, deal with that at a later date, because we'll talk, I think, in a bit about what it is InRange does as a model, but specifically to kind of get out in front of that oversize up front, and what you can do with that energy that's not being consumed on site is really, you know, where we find the market. But especially, you know, the grid is a challenge. I completely agree with you. It's become, I think, everyone's biggest headache and hurdle in this case. The one thing to consider is always to try to do it at scale. And, you know, it's easy to, or it's probably more simple to think about it in terms of individual properties, but when you can do it across portfolio and you're working with the DNOs up front and you're able to go and say, we're going to apply for several at once, and we're going to work with you alongside that process. So it's not just a constant iterative one at a time. We find that that's usually kind of more the, let's say, preferred route, if you will, to acceptance.
Yeah, it's very interesting to hear. So like, as I was working from the occupier side on the global renewables programs, right? Like we were really pushing to having that integrated and collaborating on that with our landlords to, to utilize the roof spaces that we have, particularly throughout our logistics network. So if there's then like like a limitation from the grid itself, that needs to be solved in a way. So because the occupier demand definitely, I would assume, is increasing here as well. So, but based on what we just heard from Chris and Ryan, Emre, maybe circling back to you, is this what you hear from other market participants in a way as well? And like I was wondering, what could reduce the concerns and be like a positive measure for value improvements there?
If I kick off, can say that there needs to be a greater consistency how solar PV is valued. So if all valuation houses just approach similar assumptions, that would be helpful for the market. And then at the moment, we don't have so many transactions in the market happening where real estate with solar PV are transacted, or it's not really transparent at the moment. The more transactions we have, it will be better for us because the comps we will be having to support our rates, discount rates, yields, and everything. And finally, I think if we have the ratio of sales to PPAs higher compared to the exports to the grid, that would be better for valuations, because when you sell through a PPA, it's usually more profitable. I could say in our example, it was 15 pence compared to 5 pence for the export to the grid. So the longer term PPAs you have in practice, then you have more guaranteed income. Hence, this would be a positive for the valuation for a higher value.
Okay, and I think this actually brings me back to also what Ryan you just announced. Like I think what we wanted to cover here as well, like following what Chris and Emre shared and what you just started mentioning a little bit as well. So in terms of on-site solar, there are various delivery models. We heard some of them already, including some non-traditional ones that also InRange covers. So would be great if you could elaborate a bit on that one.
Well, look, I want to touch on something that Emre just said there about PPAs being perhaps more profitable in the longer term. That's principally looking at the export, but on site, what you're able to achieve, we think, is also there's more profit to be had in the long run. First and foremost, you want to deliver for the existing tenant, and that's always going to be priority number one. You want to reduce their operational emissions, their energy costs on site, before you're taking advantage of the rest of the roof that, let's face it, is frankly owned temporarily by your on-site tenant, at least for a finite term. Inherently, too, if you're taking steps to make occupying your space a cost-saving measure, because that's what it starts to become when you're reducing those operational costs, they're a more grounded or sticky tenant, if you will. But the upside of exporting that energy, that's what we believe is a latent market, one that we valued at north of 2 billion here in the UK alone. That was kind of the subject of our last webinar. So if I'm going to give a shameless plug there, but getting creative with how you structure that export PPA enables you to potentially service your customer offsite, and even perhaps in your peers or your competitors, their lease facility across the country. You enable your tenant to procure energy in a cost-saving and sustainable manner that really kind of starts to empower their overall energy strategy and allows them to somewhat take ownership of it, if you will. But the potential exists with how you finance your delivery too as well. InRange offers two models as of today. One where the property owner will own the assets, will outlay the capital, and can finance and take that forward, but allows a company like InRange to operate and manage and maintain, distribute the energy, allow for energy optimization, build the marketplace where you might see upside in that export, and then really the trick of managing and reconciling the billing process, effectively becoming what is an outsourced energy team. The other model that we like to operate on is basically the exact same. It's just the changes who's deploying the capital. So that's where InRange would come in and outlay the initial upfront costs, owns the assets, but still has a profit share with the landlord or the property owner. The biggest hurdle beyond perhaps the remaining unexpired lease term, becomes, at least in the UK, the FRI lease. There are ways, though, in which you can provide securitization and guarantees so that you can variate the lease and ensure that all three parties benefit, and that'll maintain the lease itself, but ultimately and especially the liquidity of your core asset, which is the property itself. It's definitely doable, and a few years ago, I think it would have seemed pretty much insurmountable, and maybe not worth it. But that's starting to change, and that's the way we see it, and that's the way we're approaching it currently.
Thank you, Ryan. So, and like based on what Ryan just shared, Chris and Emre, like looking at those delivery models and opportunities there, what do you think could help unlock like these current value constraints or valuation constraints that were shared, and why?
I'm happy to come in first on that. FRI lease is key, and maintaining that FRI lease is key. And Emre, I think you would agree from a valuation perspective, if I don't have those three letters, it significantly impacts the valuation of my unit. So actually, if we go back, Peter, to the question that you asked me earlier about, what are the key challenges? I suppose the one that I didn't put in there is thinking about this at the right time, particularly on new build that we're doing. We are very confident now, and we've gone through the valuation process, that we have been able to maintain that FRI lease with landlord solar on the roof, utilizing a kind of a commercial model where we're working with partners such as InRange to maximize that export value of the energy. So yeah, I think particularly picking up on that point from Ryan, that really is key, and I agree. I've been trying to do this at Harworth for probably 6 or 7 years, and right at the beginning, there was no chance. But we are now in a position where actually it is happening, and it's happening at speed, and it really is going to kick off in the next couple of years.
Mm-hmm. Yeah, and just to add on that, so we talked about PPAs, and in the valuations, once the PPA expires, let's say in year 10, we would go all the way down to the grid price, where would the export to grid price. So all the way going from 15 to 5 doesn't sound too right. So you're losing a lot of value there. Therefore, it is helpful if the access is not exported to the grid at grid price, but there are agreements done with energy brokers or different parties, so that at least you sell a portion of it or all of it to another party, so that you don't have 5 pence in your valuation, but maybe 10. And this morning I was reading an interview with Greg Jackson. He was talking about a wind club they're launching, already launched. So what they're doing is, some postcodes which are closer to wind farms, onshore and offshore, will be getting energy. This is customers 20 to 50% discount. So similarly, why not the rooftop solar PV? You sell, export to the grid, but also sell a portion of your energy to nearby occupiers. This could be even residentials or industrials or any other parties.
That's an interesting bit, because it changes the attractiveness of some submarkets to a degree. I'm not saying that would be a leading decision, but it is a contributing decision. If you're able to achieve cheaper energy by being in closer proximity to what would be a ground-mounted plant, it maybe twinges your approach to your property strategy if you're an occupier. And at least that's the way I'm thinking about it. So bringing it back to what we're concerned about here today, if that power plant is just a building next door, there's frankly no difference between being next to that large shed versus being next to the wind farm.
It's an interesting concept that reminds me a bit of what we've also done in the US in some states where they incentivize, it's called community solar, basically, where you provide solar energy for the local community so that they can get discounted rates, even if you're not as an occupier or as the occupier use it, but you could offer it to your employees as well if they live in the, nearby. So there are a lot of interesting delivery models out there. So if anyone is interested, like community solar in the US is growing also. But yeah, jumping back to you, Ryan. So what I would be interested is a bit is like how your discussions with both the occupiers and investors actually go. So do you think there's so we heard a lot of like pros and cons now, but do you think there's an imbalance of like the goals and expectations on both sides, or how do they overlap, and how were you able to basically solve those?
Yeah, so I kind of mentioned it a minute ago or two that the unexpired lease term can be perceived as a hurdle. The payback of the install is all too often exceeds the remaining term, and possibly even the next term if it's a short-term minded 3PL on a shed. But the costs have come in, and we try to target a 30% reduction on an install cost to hit those payback targets. But there's always then the problem with the consumption. So it's great to have a refrigerated grocery unit or an e-fulfillment center who consumes heaps of energy on site. But when it's a pure storage facility that uses energy efficient LED lighting, there's not much active consumption on site. So what can you do? And that's where the oversized install might pay off if you're able to achieve Emery, you just talked about it, a better than market rate export tariff. We see them sometimes at 2 to 3x what you're able to achieve on the grid. Plus you can, another approach we take is you safeguard against a void period by generating revenue in what we call a void PPA. So you make that asset work when it's not supposed to in a way. And then oftentimes the disconnect becomes the landlord wants to rentalize the energy. And I'm not going to sit here and tell you that that's necessarily wrong. But while it looks sensible from a cash flow basis on the rent, there's inherent operational costs, the maintenance, the management. You talked earlier, Emery, about owning and operating. The bit about operating, I think, always kind of gets lost. How do you reconcile the consumption and generation on a month-to-month basis, often leading to perhaps a relationship damaging implication with your on-site occupier, by tying that static rent to dynamic energy. PPAs are flexible, they're transferable, they can go beyond the building, which from an occupier standpoint, they may have a preferred price in mind, and that doesn't necessarily go across their whole building portfolio in rentalization. What works for one landlord or location likely doesn't work for another. And when you have dozens or even hundreds of locations and landlords, managing your energy procurement strategy alongside your property strategy becomes exceedingly difficult. And I think we all agree that adding difficulty is the last thing any of us want to accomplish. Energy procurement tends to prefer to see one uniform PPA term that they can rip, apply, and go across the portfolio. So we're trying to get energy and property to work as one and not against each other. And then perhaps maybe the last point to consider is often disconnect in net zero carbon strategy. Whether it's landlord or occupiers, some are looking upstream, some looking downstream to reduce their overall carbon dependency. We're trying to streamline that bit as much as possible with actionable and achievable steps, and frankly, transparency in carbon reporting as well. I think you're muted, Peter.
Yeah, sorry. No, that's great. And I think this leads me to a last question a little bit. Like net zero is being pushed more and more from the occupier side, right? Like there are a lot of occupiers that are targeting net zero 2030, 2035, 2040, whatever it might be. And that at the end of the day follows through their energy procurement strategy as well as building strategy or portfolio strategy in terms of real estate, what they're going to rent, right? So particularly like in continental Europe, there's lots of pressure on that from the occupier side as well. So maybe Chris, as a lot of occupiers target net zero goals now in line with these international, like all sorts of international agreements and regulatory requirements, right? So have you as a company, have you thought about that as well? And like, do you see like the net zero capabilities as a demand driver for your assets?
Yeah, so it's an interesting one. Yeah, I mean, Harworth, like a number of businesses, we launched our own NetZero pathway in April 2023, and we've got some pretty challenging targets that we've put in there. We want to, as a business, to be net zero carbon for scope 1, 2, and 3 by 2030. And then we've also said for new developments and our investment portfolio, we want those to be net zero carbon by 2040. Now, I think when this concept was thought about as a business, possibly it wasn't given us as much thought widely as it should have, but actually it's been really impressive of how it's already changed the mindset of the business, of how we're approaching things, and it's all the small incremental changes that have really added to it. Within that net zero pathway, that there are some specific commercial property targets that we've put. We have said that we will offer PPAs for all of our new commercial units, and that we are going to put in place a transition to get all of our commercial buildings to grade A by 2027, whatever that grade A means. But you know, it's you know, we can all be success to that. But it's been successful. So in 2023, we've already rolled out nearly 7,000 square meters of solar onto our portfolio, which is generating, you know, just shy of 1,500 kilowatt peak. But the key thing is we've reinforced all of those roofs so that when tenant demand comes in, we are able to expand that out to around 38,000 meters squared from the 2023 delivery. I think it's something that particularly investors and occupiers are picking up on now. And actually, particularly those that are more attuned, those that are slightly more educated in this sphere, are really looking at it. And it's something that I think can start to differentiate the product within the market. I don't know if Emery might be able to comment on this, but we are starting to see a kind of two-tier market approaching, which is those with solar and those without. Now, typically, there's been a kind of sliding scale on units of, you know, EPC based. You know, higher EPC, you might knock a certain amount of pence off per square foot. But we're seeing now that the market's really having a distinct split. There are those larger, Peter, as you say, energy conscious occupiers who are striving, and this is all they want, and particularly investors, you know, this is all they want. And we are seeing that there's certain parts of the market which are going to get to a cliff edge, and the values are really going to be impacted on that. I do come back to the point that I said earlier, though, that it's not all occupiers and it's not all agents who are quite caught up with this yet. And, you know, we really need that education piece, and actually part of what Ryan and the InRange guys do really well is provide developers and landlords with the correct documentation to be able to present to the occupier exactly why we're doing it, but more importantly, why they're going to win as well. Why actually all round this is a really good product that we should be looking at.
All right.
I'm going to go on mute. I'm going to go on mute because we're about to have a fire alarm test at this end.
It's probably a good time for me to say, though, not a shot at you, Chris, but you said not all occupiers, not all agents. I can also say that not all investors are still there yet. So we know there's still even more education to go out, and that's why, you know, we're doing these types of sessions like this.
All right. I think that has been great. I would suggest we are now opening the floor. So I think our intention was to give you an overview of the current market situation in the UK, opportunities and challenges of on-site solar, the impact on its valuations, occupier as well as investor developer views, and all types of delivery models, right? That we wanted to share with you to unlock the potential that we believe on-site solar provides. So if you have any questions, please raise your hand, and then we will make you a contributor, and then you can unmute your mic.
I think we got one already.
All right.
Hi, good morning. Can you hear me?
Yeah.
Yes.
Thank you, guys. That was very, very informative. I couldn't join at the start of the hour, but whatever I heard was incredibly useful. My question is slightly adjacent to solar, and it has to do with electric vehicles and the fact that EV batteries are basically energy assets and provide property owners an interesting opportunity to use the energy in those batteries to either sell back to the grid or export as part of a PPA. So I'm curious to hear what your take is in terms of the potential challenges, hurdles, obstacles. Sort of happy to hear your opinion, guys.
If I'm just going to get started with one bit here. I mean, we know it's coming. Depending which source you hear from, the scale and the breadth of how much is coming down the road is debatable. But selfishly, this is why we come back to the oversize and the export that we talked about earlier almost becomes a hedge, if you will, if you oversize until that active consumption goes on site. Because once fleets do become electrified, either whether that's your commercial vehicles or your employee vehicles, or even if you're going to open it up to public, your on-site demand is going to far exponentially grow. And our belief is that if you've oversized and you've been exporting, the economics start to change because we know that you can charge 2 to 3x on-site energy more than you would if you export, if that makes sense. So, we believe that get as much solar on as possible, generate as much energy on site so you can control it, so that if you do see a sharp increase, it almost justifies that investment case, if you will.
Yeah.
Okay. Thank you, Ryan.
Maybe I can quickly continue. Last week, I attended a summit, Aurora London Energy Summit. Their BESS was discussed a lot. So what we find out is when you want to put a battery in your project at the moment or up until a few months ago, it wasn't really financially feasible to add it if it's a logistics or there's a site where consumption is not high. But if it's a residential where you run it 24 hours or a hotel, battery makes sense. But financially, it wasn't making sense. Having said that, the price of batteries had gone by 30% in the past month. So the trend is going down, just like the solar panel costs. In the past 10 years, they went down by 90%. The same is expected for batteries. When you have, we call it co-location, when you have solar PV and battery, then you can capture it and then sell it at the right time at the right price. And the study by Aurora was showing that typically the IRR you would expect at the solar PV is between 10 to 15%. They were proving in their case study that you would have an uplift in the IRR. So if it's 11%, that would become 12.5. So batteries in the near future will be getting cheaper. And once you adopt it to your projects, you might be expecting an uplift with your IRRs.
I'll just come in from our experience. So completely what Emery says. So far, we've not managed to get co-location of batteries stack up financially. However, what we have been doing to future-proof this is when we're going in for planning, we will show a battery as a footprint so that we can future-proof it. We will make sure that we're putting the ducting in. Same with EV as well. If we are doing big logistics, we make sure that it's already there. It's just a case of plugging it in the future. But yeah, at the moment, we just can't quite get the financials to stack up.
Got it. Thank you, gentlemen. Appreciate it.
The last thing I'll say, and I'll be brief, is it just helps. It's not as simple as just slapping a battery on or slapping EV on. It's helpful upfront to know what is the consumption profile of the existing tenant, and then frankly, who your prospective tenants could be in 5, 10 years, 20 years time. We know certain profiles are different, as I mentioned earlier, let's say a grocer versus a 3PL, but getting that information up front and trying to analyze that, as Chris mentioned, of getting that out in front, it's paramount to know what is going to be our energy strategy for a specific asset.
Understood. Thank you. Cheers.
Thank you, Jayesh. Any other questions from our listeners? Please raise your hand if you have any.
Maybe take one of the ones that had came in via email.
So what we received is for example, one general question, do you see a demand in the market for additional capacity for green energy PPAs? And how flexible could the terms of those agreements be? Who would like to start with that one?
I mean, let's start. The answer is yes. From the parts of the market which are already focused on this, yes. Green energy, green lease terms in general, and PPAs. We are still getting some form of reluctance from certain people because the way these things will work is we will need to know more data from our tenants. You know, key to this is understanding their use, as Ryan says. Key to this is understanding what they're going to do. And again, there is still a certain amount of reluctance that what are we as the landlord going to do with this data? How are we going to manipulate this data at rent review, at lease renewal, at some lease event to kind of utilize it? I think those parts of the market though that understand the benefits of what we're wanting to do and why we want to do it, yes, we are definitely seeing the start of premiums coming on smarter buildings that are looking at this.
Just touching off your point there about the data, I think I've heard the phrase, I don't want my landlord knowing anything about my energy consumption. So why would I share that with them? I've heard that numerous times. And that's why I came back to it a few moments ago. Separating your energy strategy from your property strategy, but getting them to play nice in the sandbox. That's where we want to try to get. Trying to blend them together probably becomes a bit of a difficult challenge, but they're not incongruent. And that's ultimately what you're trying to get out in front of.
Well, it's interesting. I think, and when we look at there's another question that is maybe somewhat could be a follow-up on that is, so maybe to you, Emre, how would the discount rates adopted for rooftop solar PV panels compare to those adopted for the real estate on which they are installed?
Okay, this is something interesting. When I first joined JLL to build the renewable energy, at the beginning I thought the rooftop solar PV has long life, low risk, 25 years, so it should definitely be keener than the yield you adopt for the real estate. But it turned out that I was wrong. After speaking to so many different departments, experts, everyone agreed that rooftop solar PV is complex. It's not as simple as it's been expected. It has its complexities, risks, and the energy prices are obviously volatile. It's not really easy to see where the prices are going. There is huge supply at the moment. It's increasing every day. Therefore, the discount rate you would adopt for the solar PV energy income is a bit higher than what you would have for a real estate, I would say.
If we just come in, what I think is great on the way that JLL are approaching this is previously, if we speak to other values, or if we go back a few years, it was in the yield, the solar was just in there, and then there might be another approach, which is actually, if you don't have it, we'll just give you a bit of a brown discount. So actually it became slightly more of a defensive measure, putting solar on, maintain the yield on the commercial, on the real estate asset. What we are really hoping through things like this webinar and through the papers and through the information that people are going to get out is that we get a slightly more consistent approach, because yes, Emre is right. If we have a unit where there is an additional tens of thousands of income per annum, that is an additional income stream that should be valued as an income stream. I would argue it's the same yield, but again, I'm agreeing mostly with the valuer, so I'm quite happy with that.
I think this is an important point. So I'm based in Berlin, in Germany, and in continental Europe and EU, there was in 2021 with new regulatory requirements, a strong push now, and sustainability push basically on real estate portfolios, which surprised quite an amount of investors, and that led to even further stronger pushes in adapting on-site solar, as well as other sustainability measures, because there are concerns that basically the assets are going to strength, to your point, Chris, of like a more of a defensive measure. So, so do you see this risk coming in the UK as well? So, and could you elaborate on that a little bit more? I would be curious to understand that.
Yeah, I think there is. You know, within commercial real estate, we all have to rely on EPCs. They're a fairly subjective approach to performance of a unit, and but what they are showing is that, you know, there are milestones, there are hurdles where we are going to have to improve EPCs on units, otherwise they will be stranded. What will happen at that point is they're still a useful unit. They're still a place of operation. I don't think it's that they become they become kind of zero value overnight, but we will create more of a two-tier market on that basis. But yeah, completely the point that you're making. There will be a need, and the easiest way to improve an EPC is to install solar. It really is. Whether that is the correct way, I don't believe in the whole EPC process. I think it's quite flawed in many ways. But yeah, solar is subject to grid planning, roof condition, structure of the unit, you know, all of these things. It is a really good option to improve it, exactly as you experienced in continental Europe.
Yeah, I think we know what the horizon is, especially from the EPC side. I don't know that that was the most sensible pathway to, let's say, net zero, but it was a very glaringly obvious, easy way to digest and understand that by 2027, by 2030, here's where your buildings need to be. And then you hear that, well, solar install can increase by 15 points on your EPC score. So that's a very quick and easy route. You know what to do. There's plenty of operators in the market to get there. And it's a defensive measure from your long-term exit strategy, from what you're looking at down the road. And you know, ultimately, it does still contribute to what could be a net zero strategy.
And Emre, is something that you hear as well, that some investors or owners, you know, are concerned about? I think you cover continental Europe as well, or EMEA even. So maybe you have some good comparison there now. Let's say UK investors, developers at the moment, think about that versus the rest of the broader EMEA region.
That's a question to Emery, yeah?
Oh, sorry.
Yeah, correct.
Yeah, so the local regulations matter a lot. Like in some countries, it's easier to sell energy, yet in some, let's say Germany, you cannot sell the energy. That's why while I was speaking, I spoke about a solution where a party would rent the panels to a related party, SPV, then the sales would be done through there. So there are things to work around that. But yeah, every country has its own regulations, subsidiaries, different things to consider. But the risk profile, when you check it, it's more or less similar in all countries. And when you build the cash flow, you have your assumptions depending on the geography. Obviously, the yield is different, the output yield is different, and degradation, availability, there are things which are common wherever you are. And inverter replacement costs wouldn't change much as well. So overall, the methodology adopted to arrive a value would be similar, but local regulations are important to understand if it's worth doing a PPA or selling to a grid. And we have, for example, we had done evaluation recently for a client, and on one of their sites in Netherlands, it wasn't making sense to sign a PPA with the tenants because it was too complex, the market wasn't ready, and they were just exporting it all 100% to the grid because there was a subsidy there. So in some countries, it might not. We just said typically it makes more sense to sign PPAs, not to export to the grid. But in cases, this can be changing. There could be outlier countries.
Thank you, Emre. So just a quick reminder, if you have any questions, please raise your hand. I think we have one more question that we received in advance. That's in your direction, Ryan. So question is that we received, what has been InRange's experience with developers, investors that may seek for options to maximize rooftop solar from the beginning? So I assume the new development and above the occupier demand.
Okay, so from a new development, write that in there. You're reducing your costs. It's not a refurbishment project. Some of the inherent costs that come with the construction process are reduced. So that just jacks up that payback, brings down the payback and jacks up your opportunity and your IRR right away from the get-go. So that is a preferred route. So if you're putting a new build together or you have a new development in scheme, you're going to want to consider what you can do to put solar. Now, if you're so forward thinking, and this is the question, we like those types of developers that are saying, let's go maximize, because as I mentioned before, there might not be active consumption now, but you're mitigating against an increase down the road. And what I mentioned was, you're probably charging 2 to 3x of on-site consumption. So the financials are there, especially if the increase. The other reason that InRange finds that attractive is because it's that marketplace dynamic of what can you do with what's not being consumed. And I mentioned the stat before that we think it's north of 2 billion today. And that just only goes up when that supply and demand starts to increase. That 5 pence to the grid, or what you're able to achieve by an export PPA at maybe 8 pence, 10 pence, 11, 12, whatever the case is, that's only going to go up with more competition in the market. So what we want to see is effectively that surplus energy be competitive, so that effectively you're coming in and you're bidding for a price to try to buy. And again, if you're able to procure it from the building next door, it even goes up further, because now you're able to reduce it from a network cost perspective. So if you're able to get out in front of that, that again, that's the people I want to work with.
Thank you, Ryan.
I think look, 50% of electricity prices is network cost.
Yeah.
If we can remove that straight away, we're all doing better out of it. And really, I think that's got to be the driver for this. That's what the NetZero policies, that's what NetZero pathways, that's what it's all about. He's about moving in the right direction. But it can have a positive impact on valuation as well, which is essentially what this whole webinar is about. It does achieve both aims and both goals.
Thank you, Chris. Do we have questions from the audience? Okay, if not, then maybe I have a question. So, Emre, I think you mentioned that developers or investors currently have, like, over their portfolio, around 5 to 25% covered with on-site solar, and their target is to reach 75% plus, right? Of on-site solar in the future. Like, could you? I would be curious to understand a bit more in terms of like what their strategy is to achieve that. So, are they looking into various like type of these delivery models that we were looking at, or at least what their current strategy tells us, as well as over what time frame?
Yeah. So many of them are a bit confused, because every other day another developer is knocking on their door, trying to persuade them to let the roof to them, coming up with projections, some with base rent only, some with base rent plus turnover rent, and they just want some objective assistance. That's why they are coming to companies like JLL, and it's not only valuation we do, we have sustainability consultancy team as well. So it's not only us, but others in the market do that too. So what their strategy is to make sure that they do the right move. Because if they agree with a third party with a contract which is not great, so it could be an obstacle for them in the future if they are able to sell the project from a liquidity perspective, it could be an obstacle. There could be many pitfalls. Therefore, their strategy is to work with consultants where they feel they have objective support for them. And yeah, majority of them are understanding that it makes more sense for them to build the panels themselves, own it. However, I had been to some calls where the asset managers told me that, okay, we understand that's the right way to do, but we are real estate people. Our expertise is not selling energy. I get you, but I still want to let it to a third party for peace of mind so that we only focus on real estate. So some investors have this strategy on mind as well.
Yeah, look, you can't become a problem or part of a problem. What you need to, one thing that we always try to harp on is you want to sell and lease buildings. That's fine. Keep doing that. We're just here to kind of give you a nice little cherry on top. So don't allow that partnership, that third party, to become predatory or prohibitive to any degree. And that's why you get out in front of that. Again, I mentioned with what you can do, even on an FRI basis, upfront to ensure that all parties are going to benefit. And if you don't get that out of the way, there's no point in proceeding.
All right. Any further questions? Ryan, Chris, Emre, maybe? Otherwise, I would have a last one, maybe. We touched about the energy or the cost savings as part of that, but how much do renewable energy credits play a role in those discussions that you have with occupiers to reduce potentially their emission, to support emission goals? I think that's important part of PPAs. Maybe a few sentences on that as well would be interesting to understand from you.
I'm happy to start on that one. Actually, this is new. So we've been doing PPAs for a while, and we've had our first kind of pushback on some pretty model PPAs, which are pretty much quite vanilla. We've had the bits about data that we would have talked about, showing data. But yeah, we've had the first kind of comments coming back about credits and about who they sit with and where they sit, and whether they are with the generator or whether they're with the consumer. I'm going to be honest, I don't have the answer for that one yet. It's relatively new, but it's interesting you raise it because yes, this is the current new curveball that's coming in, where we are all becoming more aware of dealing with our carbon emissions and looking for the credits. I mean, it's a bit of a shameless plug. As Harworth, we've gone for a woodland carbon code tree planting approach on surplus land that we've got within the portfolio. So that's kind of where we're looking at after a reduction and after a reduce to kind of deal with our residual. But yeah, it's a really interesting point. I'd be interested in what the other guys on the panel thought, actually, personally, on this one.
First off, do all the shameless plugs you want. I think I've dropped about 3 in here on this in the last hour. Yeah, I've seen deals fall apart because the ownership of that credit is misunderstood or misaligned. So it becomes, again, get this a lot out of the way. That's what I talked about earlier about injecting greater transparency. I think it needs to be better understood. Now, look, I got to caution you guys here. I'm getting the battery saver notice here, so if I have to just get disconnected, that's why. But yeah, it's what I'm trying to establish is that it is becoming more of a focal point. It's more sophisticated energy buyers. It's tantamount to progressing with a deal.
Thank you. All right, I think we are on time. If there are no further questions, yeah, thank you everyone for joining. Thank you to all of you, to the panel. Super interesting discussion. Appreciate having the opportunity to go through that with all of you. And yeah, recording will be shared tomorrow.
Thank you, Peter.
Thank you.